The FTSE 100 closed up 1.6% on Thursday, finishing at 10,378.82. Oil prices eased from Wednesday's 125 peak. The Bank of England held rates at 3.75%, 8 votes to 1. On the surface, it looked like a straightforward relief rally. Energy fears stepped back, a central bank held firm, and equities followed the script. But something else happened that didn't fit. United Utilities, a water company operating in northwest England, saw its share price surge 11% in a single session. On the same day, the company announced it was issuing £800 million in new shares. Normally, when a company floods the market with fresh equity, existing shareholders brace for dilution, and the stock falls. That is the textbook reaction. Thursday's market didn't read the textbook. Meanwhile, the BOE's hold was more warning than relief. Chief economist Hugh Pill cast the sole dissenting vote. He wanted a quarter-point hike to 4% immediately. Governor Andrew Bailey said the war in the Middle East was driving inflation higher. The bank's April monetary policy report outlined 3 scenarios. Across all of them, inflation runs hotter in the near term than February's forecast. And in a scenario where oil holds at $125 for the rest of 2026, UK rates may need to climb above 5% before year-end. That's the backdrop, a central bank signaling it might have to tighten aggressively, an energy shock still unresolved, and local elections in 6 days that Standard Chartered analysts say could trigger a Labour leadership challenge. Gilt yields are the market's barometer of whoever might replace Starmer. This is not a calm environment. And into that environment, a utility just raised £800 million and went up 11%.
The instinct is to ask what went wrong with the market's arithmetic. It didn't go wrong. The arithmetic changed. United Utilities' regulatory model is built around something called the regulatory asset base. Ofwat, the UK water regulator, allows companies to earn a permitted rate of return on their asset base. The higher the asset base, the higher the permitted earnings. When a water company raises capital to invest in infrastructure, pipes, treatment plants, flood resilience, it isn't just spending money. It is growing the asset base that future revenues are calculated against. The £800 million equity raise is not dilution in the traditional sense. It is an investment announcement. Investors who buy the new shares are buying into a business with a larger regulated asset base, and therefore a legally protected earnings stream that grows with that investment. In the current regulatory cycle, Ofwat has approved significantly higher bill increases to fund infrastructure catch-up. United Utilities in the Northwest and Severn Trent in the Midlands are positioned to benefit directly. Thames Water is the visible casualty. It absorbs headlines about debt, creditors, and administration risk. It has become a lens through which people view the entire sector. But Thames's problems, extreme leverage, historic underinvestment, regulator friction, are specific to Thames. The rest of the sector has a different balance sheet, different regulator relationship, and a different trajectory. Here, though, is the condition that makes the entire thesis fragile. United Utilities' 11% gain rests on the assumption that Ofwat's current allowed return remains in place, and that future regulatory reviews don't claw it back. Regulatory resets happen every 5 years. The 2029 review is not priced in, and if a new government, possibly one that emerges from the political turbulence 6 days from now, decides water returns are politically unacceptable, the asset-based model can be rewritten faster than the infrastructure it funds.
The BOE's 3-scenario framework is itself a signal. Central banks don't publish 3 inflation paths unless they genuinely don't know which one they're on. The 8-to-1 vote, with Hugh Pill alone pushing for an immediate hike, tells you the committee is closer to tightening than the headline hold implies. If the Strait of Hormuz remains closed into summer, the oil-driven scenario becomes central rather than tail risk. In that case, the 5% plus rate path is not a warning. It is a forecast. For United Utilities, rising rates cut in 2 directions. Higher rates increase the company's cost of debt on the £800 million it just raised. They also raise the risk-free rate that Ofwat uses to calculate allowed returns, which in theory should flow through to higher permitted earnings. Whether the regulatory mechanism catches up faster than the financing cost rises is the live question. The political dimension arrives quickly. Local elections on May 7th cover more than 5,000 council seats and the full Scottish and Welsh parliaments. Standard Chartered sees gilt yields as the financial market's verdict on whoever might succeed Starmer. A leadership contest would bring fiscal policy back into question. Gilt yields already crossed 5% for the first time since 2008 earlier this week. A second move through 5%, this time driven by political uncertainty rather than energy alone, would reframe the risk premium on everything denominated in sterling. The evidence as it stands points toward United Utilities retaining its gains, provided the regulatory compact holds and rates do not spike faster than Ofwat's review cycle. Severn Trent's parallel performance confirms this isn't a one-company story, it's a sector re-rating. But the thesis depends on a political stability that the next 6 days may test. If Starmer's position becomes untenable and gilt yields surge on leadership uncertainty, even a well-capitalized water company with a growing regulated asset base does not escape unscathed. Watch the 10-year gilt yield on the evening of May 7th. If it holds below 5%, the water re-rating continues. If it breaks above 5% on political news rather than oil, the mechanism that just sent United Utilities up 11% faces a harder question.